What we want to go through are just a couple steps as it relates to take after the audit is complete. I know everybody enjoys the audit process and you want your auditors to stay longer, but this presentation is more geared towards when the audit is complete, just some items that you can take or some actions that you can do after the audit is complete. And I realize not everybody wants your auditors on site. That was just a lame attempt at a joke to start out with there. So a little bit about me on the next slide. I'm a member of the firm here with SEK. That stands for Smith, Elliott, Kearns & Company. We're a CPA firm located in South Central Pennsylvania. Personally, I joined the firm in 2004, and I have over 17 years of experience. I still remember back to when I started. The member of the firm at the time came to me and said, you should join, or you should do the 401k that we have. And I looked at him in the eye and said, there's no way I can run that far. So unfortunately, that's my only other lame attempt at a joke that I'll have for you here today. But you can see I graduated from Shippensburg. And again, what I focus on primarily are audits of local governments, including townships. Just a little bit there about other presentations that I have done, both internally and externally. So just the agenda for what we're going to cover here this afternoon. A couple different things to try to break it up a little bit, but all geared to steps to take after the audit is complete. So the first four items are the items that we're going to cover here, broken down into four categories. First, we're going to go over what to communicate in between your audits. Again, your auditors are typically on site for a relatively short amount of time. So what to communicate, what needs to be communicated in between? What else can be added to a list that's maybe communicated when the next audit is started or next time you communicate with them? Also, we're just going to briefly touch base on the board's review of the audit. I'm not sure if there's any supervisors here on the call today, but if so, a little bit about what that information should be reviewed as part of the audit. And a lot of times, I'm sure as management of townships or the board are asking, what should we be doing as part of the audit? So those are just a couple of slides there that can be passed on to them. Obviously, as management, you have a significant role in completing the audit. So what does your review of the audit look like? And then finally, we just have some potential areas in which your organization can improve the audit. So these are just going through significant audit areas and where we kind of see maybe clients have gotten tripped up in the past or where the most common deficiencies are. Obviously, there's disclosures, those, and just offer some other areas in which your organization could potentially improve during that time period. So we're going to kind of dive right in and go through what to communicate in between the audits. And again, I think some of these should be communicated immediately, while others, you can wait a little bit. It doesn't necessarily have to be something occurs that you're letting the auditor know every time one of these items occur, but maybe you can make a list for items to communicate to your auditor. And the next time you either talk to them or maybe you just shoot them an email to let them know. And that way you just kind of have a list and they're up to speed as well in any changes that you may be having at the township. So the first and foremost item that we have, I hope that nobody on this call ever has to go through this, but if you ever run into fraud or any potential irregularities, obviously you want to contact your auditor immediately. That is a phone call that you'll want to make and connect with them as soon as possible, and that way they can be in the loop and if they need to be involved in the process as well. So that's considered a compliance issue. Again, a lot of times, hopefully you're not running into that, but if you do want to contact your auditors as well as any potential, if you need to contact the police, depending on what the fraud is that occurred or any other potential irregularities that you see. And when I say irregularities, as management, if you're just seeing something within the accounting records that just doesn't look normal, and you kind of want the auditors to take a second look at it, it can be necessarily out. It doesn't necessarily have to be part of the audit. It can be outside of the scope of the audit, and maybe additional or other procedures can be performed to review those irregularities just to see if there's anything there or not. The other second bullet point, I know this is a hot button topic for a lot of our township, is the ARPA funding comes into play, but that's any new compliance requirements. Obviously, the ARPA funding that the townships are started to receive or will soon be receiving, as with any federal grant, there's additional compliance requirements that come along with those. So you just want your auditors to be aware of those. We'll get into the details later about what entails a single audit, but depending on what type of grant you have, if there's new compliance associated with that, that could change the scope of the audit. So your auditors will just need to be made aware of that and need to be aware of what those compliance requirements are and what the compliance items that'll have to be tested as part of the audit. Also, you just want to go through any designations of fund balance. I realize on the call we may have a variety. Your audit may encompass just what's known as the DCD report. That's the report that's filed to the state that's due April 1st of each year. And while all townships have to complete that DCD report, there's others that still complete what I'll consider a full set of financial statements. And that full set of financial statements still just offers a lot of the similar financial information, breaks it down a little bit more detail by fund. There's also what's known as the government-wide level, and a lot of footnotes that are included as part of that. So the fund balance designation is really more geared towards the full set of financial statements, because there isn't a separate place for the fund balance designations for those individuals or individual townships that are just completing the DCD report. So the fund balance designations, again, typically you have unrestricted or restricted fund balance. If it's unrestricted, you could break it down into committed, assigned, or unassigned fund balance. And that's typically where board action is taken to commit those for future potential uses. So if you make designations, obviously that's in the board minutes where that's approved, but you just want to communicate those to your auditors so that they can be appropriately reported within the financial statements. The second large bullet point that I'll turn your attention to are just changes in internal controls. And those can look in a lot of different fashions here. The first one that we have listed is obviously if you go through a new accounting software or new accounting system, you want to incorporate that and make sure that your auditors are aware of that. What we typically try to say, it's not that we have to be involved in that process. Obviously, as the auditors, we're not in your software other than maybe for a couple of days to a couple of weeks, depending on the size of your township. But we may be able to offer some insight as to what that accounting system looks like. We may have other clients that use that same accounting software, and maybe we can pass on that information to you just to help with that transition of that process. And again, similarly, as we make requests as it relates to our audit, if you change accounting systems, a lot of times our requests may look a little bit different. Previously, what may have been run out of the old software system is something a little bit different. So we just want to make sure that we're on the same page in the information that we're requesting as it relates to the audit accounting system. Also, if you have any significant changes in personnel, obviously within the township office, depending again on your size, you could have anywhere from one individual that's involved with the accounting up to 5 or 6, depending on the size of the township, or maybe even more. So if you have any significant changes in those personnel, you want to communicate those to your auditors as well. Typically, if you're a small township and the secretary treasurer, but if they're larger and you have either somebody with the cash receipts function, the accounts payable, or the payroll, those are more significant changes, or a township manager that should be communicated to your auditors on a regular basis. And then the last bullet point, I think this one's become a little more prevalent here over the last 18 months, but just any other major changes to policies and procedures. I'll say for the most part, I realize governments, obviously you've had to continue to be in operation during this entire COVID issue that has arisen, obviously, but there may have been policies and procedures that have changed during that time period. So because of that, I'm not sure there's any governmental entity that's working exactly how they were 18 months ago before the COVID pandemic interrupted the operations. But any other changes that are made to the policies and procedures, again, you want to communicate those to your auditors, as they typically have to go through what's considered a risk assessment as it relates to your internal controls. So you just want to make sure that they understand what the policies are, what the procedures are, again, for those main accounting functions. So how is information recorded in the accounting system? How is accounts payable? How are invoices paid for your cash disbursement side of things? Is the payroll operation changed? Maybe it was manual timesheets before, or maybe now that's a little more automated. So you just want to make sure that your auditors have that understanding of how those processes are taking place. So what are some other pieces of information that can be communicated to your auditors? I'll typically say any large or unusual transactions, they'll want to be in the loop as well. So the most common example that we have are just any new debt issuances that are issued during the year. You want to make sure that your auditors are aware of that. Obviously, if you issue new debt for a large project and maybe all those funds aren't spent, there's going to be a new cash account that'll be there as part of the audit. So that'll be obviously streamlined, and they'll be able to see that relatively easily within your general ledger system. However, if you go through a refinancing activity, that activity may not be accounted for on your general ledger. You may just be making new payments related to the new debt, but there are entries to be made that the auditors can assist with. And that's basically just to gross up that activity. You're eliminating or removing the old debt or recording the new debt as well to get that on there. So whether it's the fund level, where it might be a governmental fund, or if you have a water or sewer fund where the actual liabilities are recorded, those entries are typically a little more convoluted, a little more complicated. So you just want to, as soon as you can, or once the debt issuance has occurred, obtain what's known as the final sources and uses. And that's a one-page document that basically just shows the debt that was issued, as well as any uses for this. So obviously there's typically costs associated with issuing of the debt issuance costs. There could be premiums, discounts, and again, if you have a refinancing, just how that as it was accounted for, and basically want to ensure that that is appropriately accounted for in your general ledger system. You also want to communicate any large contracts, or excuse me, that should say contracts, not contacts there, but any large contracts that are entered into during the year. So if you have a large project that's going to be coming up, you may go into planning for that, and then you're ultimately going to sign a contract for that project. And basically you want to make sure that that is communicated to your auditors, as there is required disclosure if you have a full set of financial statements, and for them just to understand what the expected expenditures are related to that project as they review your accounting system and the accounting ledger as part of that. And then finally, I'll just say any other complex accounting entries. Maybe you run into something that is not typical. Maybe you receive insurance proceeds for some reason. Maybe there was an accident and you receive reimbursement that's just non-recurring, non-common, or maybe it's an unusual payroll transaction. Somebody retires and you just need help with the recording of that transaction. We really just recommend, again, to reach out to your auditors, make them aware of them, and just communicate that at the time that it's occurring. So when it comes to all these large or unusual transactions, what we really recommend to our clients is to contact us during that process. Obviously, we can make the entry when we come out to complete the audit, but it's much easier from your standpoint if we start asking for questions or additional information. While it's still fresh in everybody's mind, it's easier to do that up front. So again, just recommend just to stay in contact with your auditors for those, and you don't need to wait for those during that process. Also, you want to go through any significant changes in finances that may have occurred. Obviously, it seems to be the opposite of what's occurring here as far as the loss of grant funding, but any new grants, again, you'll want to communicate to your auditors. But on the flip side, if you have a grant that you were receiving on a regular basis and for whatever reason you're no longer receiving that, again, make your auditors aware of that, because that could have an impact on the audit in the future, and that just helps them plan and account for that. Also, if you, for some reason, had any potential disallowances of any grant funding, so if you have a grant and maybe they disallowed certain expenditures and maybe there were amounts that had to be paid back, again, as your auditors, we just want to be made aware of that so that we can properly account for that in your financial statements. The next item, not too common for governmental entities, but if for some reason there were a loss of major funding source, you want to communicate that as well. The most common example I can think of is if you're a township that were to have water and sewer, and maybe you had a business that went out of operation and nobody has bought that. So maybe you have a steep decline as it relates to the water or sewer sources or revenue streams coming from that entity. Again, with taxes, obviously typically going to be paid from year to year from a property tax standpoint, even if that company were to go out of business. And once that's sold, obviously you're going to receive all those property taxes. So a little bit, again, less common. But if you do have any other significant changes in funding sources, you'll just want to communicate those as well. And then the final item, again, if you do issue only a DCED report, this will not have any impact. But if you do issue a full set of financial statements, this could have an impact. Basically, if you have a capital asset, so if you were to have a sewer plant, for example, that for some reason becomes impaired, maybe that sewer system is no longer in operations and you had to build a new system, then that old system is considered to be impaired. And basically, you're going to bring that value down of that asset and no longer depreciate that over time. So again, typically more common for a water sewer operation occasionally, but for any reason a capital asset were to become impaired, you would just want to account for that appropriately. So again, that can be a little bit complex on determining that impairment and what value to include that or to account for that on the financial statements. So if you have any potential impairments, again, you just want to communicate those to your auditors at the time of that potential impairment. And then I'll just say, when it comes to completing an audit and being your auditors, we want to be we want to help. And anytime you may run into something that feel like you need help or need consultation for, it can't hurt to check with your auditors. I know sometimes, unfortunately, somebody may ask a question that's more legal, on the legal side of things, and we may, again, push them to check with their attorney for that. But if there's anything else that we can do as part of your auditors, whether it's a time study related to your employees or just anything from a financial standpoint, if it's consultation with grants or with ARPA funding, again, your auditors can at least give you their guidance on that, or at least bounce it off of them, and they might be able to, again, put you in contact with somebody else who's gone through a similar process and be able to help with that. So next, I'm just going to turn your attention now briefly to the board's review of the audit. And again, I realize there may or may not be any supervisors here on the webinar today, but I did just want to offer some information as it relates to what should they be reviewing. Because I know a lot of times somebody may come onto the board and the audit may not be at the top of their priority list, or again, the financial side of things, they might not be as in tune with. We realize not everybody is an accountant by nature, especially those on the board, but we just kind of want them to have an understanding of what their fiduciary responsibility is as it relates to the audit, as they are township supervisors. So most commonly, typically what we do for a lot of our clients is present the audits once it is completed to the board, or maybe we're providing that information to management to ultimately make that presentation to the board members themselves. So a lot of times, again, that communication is just providing them with those documents and just going over the high-level results of the audit. But what really should the board be looking at? And I think some of the highlights that we typically include when we do board presentations, and some of this is baked into the other documents that are related to the audit, which I'll cover when we get to the management's review of the audit. But first and foremost, ultimately, were there any difficulties in getting the information? And when I say that, it basically, were there any issues in completing the audit? And again, it's typically the audits are done on the same time frame from year to year. Again, with the DCD report, it's due on April 1st. Then if you issue a full set of financial statements, that may typically be issued in April or May timeframe. And basically, were there any difficulties in going through that process? And the board needs to have that understanding if there were, just so that they can be made aware. And again, if any decisions need to be made, they can do so. So I think what goes into that, and again, the 3 bullet points below that, again, was the information received on a timely basis? Was it correct when it was received? And that kind of goes hand in hand with the bottom item that we have related to journal entries. So I'll circle back to that briefly. But also, did management impose any limitations? I'll say in the 17 years that I've been auditing, for the most part, we haven't had any issues in completing the audit, whether it was imposing limitations. Again, sometimes there might be turnover at some of our clients, and maybe the audit drags out a little bit longer than what it was accustomed to. Obviously, with COVID, that kind of changed the game as well. There were some clients where we were still able to go out on site. There were others where we needed to perform it remotely and send documents in electronic format. So that just kind of changed the dynamic of the audit and how they were ultimately completed. So as you go through that, just need to keep those in mind. Just because it might have been slightly delayed doesn't mean necessarily that there's anything wrong, but just for the board to have that general understanding. And then the third bullet point, if there were to be any disagreements with management on accounting principles, we would obviously want to communicate those with the board during that process. So even though we work with management to complete the audit, again, as your auditors, we are hired by the township supervisors and doing a service for the township, even though the majority of our communication may be with management. So if there were to be any issues, we would be communicating those with the board as it relates to the audit process. And then the final bullet point, which I alluded to earlier, are just for any significant journal entries. Obviously, as part of any audit, for the most part, we typically have journal entries that we make. And those journal entries can be ranging in nature from 1 or 2 journal entries to significant journal entries that are made. And that's not necessarily a bad thing. A lot of times, a lot of our clients are recording information on the cash basis and then adjusting that either to the modified accrual basis of accounting for governmental funds or for the full accrual basis for those proprietary funds. And there's nothing alarming or there's nothing unusual about that. A lot of times that information is summarized by our clients, and maybe we're just making the journal entries as part of the audit process that ultimately flow into the financial statement. So we typically try to go over that with boards just so they can have an understanding of what those journal entries are and whether or not they were unusual or infrequent, or if there were any internal control matters related to the journal entries that were provided. So that kind of goes hand in hand with getting the information correct, although it's not a direct correlation between the number of journal entries and whether the information was correct. But sometimes that can have an impact on the journal entries that are included. Also, as part of the board's review, we typically try to go through what the areas are for improvement. There's what's known as findings. Obviously, nobody likes findings as it relates to the audit. Those are known as either significant deficiencies or material weaknesses. Obviously, if we come across anything that were to rise to the level of a finding, we'd have to report on those. That typically goes in what's known as our SAS 115 or what's known as our management letter. And we would just go through those details with management as well as the board. But the board would need to have an understanding of what that finding was and how it can be corrected going forward and what management's take is on that as well. Also, if there were any recommendations from previous years, obviously from the board's perspective, they would just want to have an understanding, was that a repeat finding? Were items corrected? Obviously, you don't want to have the same finding year after year, other than if you were to have a significant deficiency or material weakness just due to having a segregation of duties or a lack of segregation of duties. For the very small townships, again, that may only have one secretary/treasurer, it's impossible to have a segregation of duties if you have one person handling all those duties. So obviously the township has to perform a cost benefit analysis. And as part of that, again, does it make sense to hire somebody else just to alleviate that? Not necessarily, but again, to perform that cost benefit analysis on a regular basis. And again, any segregation of duties that you can put in place, whether it's adding dual check signers, or maybe it's a supervisor coming in daily to open up the mail if that's a possibility, that just helps obviously with those segregation of duties. And then in looking at the audit as well, moving to the financial health of the township. Again, I realize a lot of times the supervisors may not be accountants by trade, but they do have the fiduciary responsibility of being supervisors and just looking at the overall financial health of the township. So as part of that, I think a big piece of that is looking at the cash balance from year to year or month to month, whatever that may be, whenever those board meetings are occurring, but at least looking at the audited information so that the information can be relied upon. It's also looking at the overall revenues and the expenses of the township and just understanding the trends over that time period. And then also, again, if you are issuing a set of financial statements as the township, just having the board members have a general understanding of any significant changes that are made to the financial statements, whether that's new accounting pronouncements or maybe that's adding new footnote disclosures. I'm not saying they need to have a complete understanding of the full financial statements because that can be very overwhelming at times. But again, just to be able to communicate what those changes were, either to the accounting pronouncements or within the footnotes disclosures that are included. And then typically the last step for the board is just to acknowledge the acceptance of the audit. Again, as your auditors, we are issuing an opinion on your financial statements. Our opinion and our piece of that is only the independent auditor's report, which is typically the first couple pages. And then the rest of the financial statements are ultimately the township's responsibility. Again, we may assist in preparing that document, but again, that is the township's document, and the auditor's report is strictly the only piece of that that is the responsibility of the auditor. So now I'll just turn your attention now briefly to what's not briefly, I shouldn't say, but to the next topic here for management's review of the audit, and a couple different topics to walk through, and I think it just kind of pulls the audit process in a whole, and hopefully will help to better explain why certain items are accounted for in certain ways and why things are done as they relate to the audit. So the first item that we have is the client representation letter. For those of you involved with the audit process, I'm guessing you probably signed or at least prepared the representation letter before. I know sometimes it's one of the last items that we need, and maybe unfortunately it's communicated and said, hey, here's the client representation letter. We need this back and signed before we can issue the final financial statements. But it's typically anywhere between a 3 to 6 page document that basically shows what you're taking responsibility for, what you're representing as it relates to the audit. So just kind of wanted to walk down through those steps. Again, I think a lot of times this kind of gets buried or lost as part of the audit is to explain why it's necessary. But again, ultimately, the financial statements are the responsibility of the township or of our clients. So that we just have to have representation made and signed on an annual basis as it relates to the information for the audit. So these representation letters, if you compare them to year, probably look fairly similar. They may change a little bit with accounting principles from year to year, but that is standard language for most of the letters that we have. So just to walk down through a couple bullet points, again, the representation letter really spells out what your responsibility as management is related to the audit, including the financial statement preparation. Even though we may be hired to prepare your financial statements, again, it's still your responsibility to oversee those services related to the financial statements because they are the township's financial statements. And that also includes those responsibilities, includes the internal controls of the organization. So again, you're just taking representation that the information you provided to us as it relates to the financial statements and related internal controls are sufficient. It also goes through that you provided communication of any key transactions as it relates to the audit so that we can properly prepare those financial statements and or audit the financial statements if they were prepared internally rather than by your external auditors. This also includes footnote disclosures, and those kind of go hand in hand here in the second and third bullet points as it relates to related party transactions and subsequent events. So again, if you're going beyond the DCD report only and are issuing a full set of financial statements, then that information is required to be disclosed as it relates to related parties and subsequent events. Most of the footnotes that are included in the financial statements are related to the other financial information that's included as part of your audit, but not necessarily everything. Again, related parties are harder to come by in the general ledger for us to identify what those related parties are. And similarly for subsequent events, if something were to occur, if it's a bond issuance that occurred after year end, we may not be made aware of that because we're looking at the audit through the year that we are issuing the opinion on. So obviously you just want to communicate that information. And again, taking sufficiency over the footnotes that they are appropriate and as detailed out in the financial statements. Also related to the audit are just a review and approval of journal entries. As I mentioned earlier, typically there are journal entries with most audits that we perform on an annual basis. You just want to have your review and approval of those journal entries, even if they're prepared by the auditors, because you're ultimately entering those into your system and want to make sure that you're on the same page as your auditors, that they are appropriate. And then also, again, just you're making sure that you're confirming that all the information was provided to the auditors as part of the audit. And again, I mentioned this earlier as communicating to your auditors, but if there's any suspected fraud or if there was fraud that was committed, you are required to communicate that to your auditors. So that's just representation here that's included in this letter as well, along with any compliance issues that you may have had. So again, hopefully that's not the case for those last two bullet points. But again, if any of those were to occur, you're just required to communicate those to us. And again, making representation about those within the letter. So next, it just turns your attention now briefly to the financial statement review. So again, now that you've completed the financial statements, you've completed the representation letter, what should your review of the actual financial statements look like? And it's going to look, again, a little bit different if you are DCD only. Obviously, you wouldn't have footnotes and there's certain information that's not going to be included. But if you are issuing the financial statements, it kind of pulls all that together. So the financial statements themselves, again, the management is required to take responsibility for the financial statements, even if they are prepared by your external auditors. But basically, what does that mean? How can you ensure that that information is correct? And again, I think it lists 5 bullet points here underneath of the financial statements on what you can review. Again, depending on the type of entity that you have, if you have governmental funds, you may have what's called the full accrual statements, where you're recording your capital assets and your long-term debt and those related items that aren't typically recorded in your governmental funds or your general fund. So those first 2 pages are typically your full accrual statements, where you're summarizing that information and providing it to your auditors to record that. And then split separately is the fund level information, which is typically how you're keeping your accounting records for either your general fund, state highway aid. Again, if you have water or sewer funds, those are accounted for there, but that's considered the fund level where you're looking at those individual funds. So what you want to do is basically ensure that the information is appropriately reported. And for that, you will look at your total assets, your total liabilities, as well as your fund balance and your net position. So that's looking more at the balance sheet side of things, but you just want to make sure that the information that's reported in your financial statement matches the information that you have in your internal accounting system. And that's mainly to make sure that your fund balance and your net position roll forward for next year and basically have your proper beginning balances as you begin your next fiscal year. You also want to take a look at the income statement side of things. Obviously, it's very easy to look at the net income amount from year to year and that's listed in your financial statements compared to your internal accounting system and make sure that that matches up. And then from there, you just want to look at any significant line items to make sure that they are appropriately reported within the financial statements. What really helps with all of this is requesting the grouping schedules. Obviously, as your auditors were preparing your financial statements, we are going through, we import your trial balance into our software, and then we are grouping each of your accounts, and that's how the information ends up on your financial statement. So I know a lot of you are thinking, well, if I look at my trial balance internally at my software, how do I get from each individual account over here to where these groupings are? And that's where that grouping schedule can really come into play and be able to provide that information. So that just breaks down each of those categories or the groupings, how they end up on the financial statement, but still provides the detail for what's included there amongst the individual account bases. Also included as part of the financial statements, again, if you are issuing a full set of financials, are the footnote disclosures. When you look at your financial statements, only the first anywhere from 3 to 10 or 12 pages there are what I would consider the face of the financial statements or the number pages. For the most part, everything behind that are your footnote disclosures, which obviously make a significant portion of the financial statements. And that can vary anywhere from 5 pages to some of our larger townships. They may be 60 pages long as far as those footnote disclosures are concerned. So first and foremost, you want to start with the reviewing of the accounting policies. That's typically in note 1, which basically summarizes the accounting policies used by the governmental entity. I used to say that that was always the longest footnote. For those of you who may have implemented GASB 68 or 75 for the pensions or the other post-employment benefit information, unfortunately, that has snowballed and just added a lot of disclosures to the financial statements that weren't previously there. So note number 1, again, is pretty typical to be note number 1 for the accounting policies and pretty standard from year to year, but you just want to review that and make sure that the information is still accurate and correct. You also want to review any financial information in the other footnotes. For example, you have a footnote on capital assets or long-term debt. You want to make sure that those amounts match the front of the financial statement. So again, your auditor should be doing that. Sometimes, unfortunately, a journal entry may change late and maybe the footnote failed to get updated. So you just want to review that as part of your process as well. And then the last piece is just reviewing it for any other missing information. You want to make sure that all the appropriate disclosures are included in your financial statements. And where I think that really comes into play, you may be thinking, well, I didn't prepare the financial statements. How am I supposed to know what should or shouldn't be included? That's why we hired you to do that process. And that's where we really just recommend to work with your auditors. We typically provide a disclosure checklist to our clients just to review that on an annual basis, just to make sure you're going through the information and in determining whether or not there should be a disclosure. So if you have a related party, again, that maybe your auditors aren't made aware of, that should be disclosed. Maybe it's a subsequent event, maybe it's a significant contract that was signed. It's some of that information that you just want to make sure is appropriately disclosed in the financial statement as appropriate. So also included as part of management's review, and again, I alluded to this earlier, but it's management's review of the audit, and it relates to what's known as the management letter, or sometimes known as the SAS 115 letter. So again, typically, unless you have a single audit where you have federal expenditures over $750,000, any findings that we have are made to related to the audit are in the separate management letter. If you do have a single audit, even though it may be the same finding related to the financial statements, it would actually be included in the financial statements themselves. So sorry to muddy the waters a little bit, and I'll certainly touch on a single audit as we get a little bit further. But basically, what's known as a finding or a communication of the internal control matters are broken down into 2 categories. The more significant of the 2 are what's known as material weakness. And that's basically, and I apologize for reading, but I just want to make sure I get this definition correct. But if there's a reasonable possibility that a material misstatement of the entity's financial statements will not be prevented. So again, that's the stronger of the 2, or the more severe of the 2 findings related to a material weakness. And basically what it's saying is that internally, there's a material weakness in internal control that could reasonably leave the possibility that a material misstatement of the financial statements would not be prevented. I know a lot of times somebody may think, well, the auditors will catch that. They're part of our internal control process. And unfortunately, that's not the case. While we may detect those issues, and hopefully, again, we're ultimately issuing an opinion that the financial statements are materially correct, as your auditors were not part of your internal control process. So you should have an internal control process ultimately to ensure that the financial statements are materially correct as well and prevent and detect any material misstatements. Significant deficiency, on the other hand, less severe in nature, but basically with just very vague definitions that would still be important enough to merit attention by the board. So again, anything that we feel the board should be made aware of as far as internal controls or an area for improvement that's needed that would warrant the attention of the board, we would typically include there as a significant deficiency. We also have typically included in those management letters just other areas of improvement. Maybe it's just something else that we feel we needed to communicate, maybe not a lack of internal controls, but just to communicate to the board. Those areas of improvement are also included in that letter. And then also typically just the new accounting pronouncements. As they'll become effective, they may have an impact on the financial statements in the future. So we try to highlight those, make you aware of those in advance, and that way you're not surprised from year to year when you're comparing that information. The key component here as well is just to review and ask questions when items are unclear. What we typically try to do is provide both your financial statements and the related letters in a draft form. We typically used to have in-person draft meetings. I know over the last 18 months, they've been a little more virtual, but whether we have it in person or virtually, just to go over the information in draft format, just to make sure that everybody is on the same page and agrees with the information before it is finalized. And sometimes with findings, you may ask the question a different way, or maybe you just kind of talk through it. Maybe something that we thought was going to be reported as a material weakness no longer is once you have that discussion and can work through that with your auditors. We really just recommend to go through that and spend the time with your auditors to make sure you have an understanding of the information that's included in the letter. The other letter that we have is just our communication with those charged with governance. So again, this letter is typically addressed to the board, and a lot of that information that I covered earlier as part of the board's review of the audit information is included here within this communication with those charged with governance. I will say that these are included here in the bullet points for the content. It's typically the same. Typically, unless we have significant issues in completing the audit or disagreements with management and accounting principles, this information is typically standard communications from year to year. If there are any difficulties or disagreements with management, or maybe they're consulting with another auditor, obviously that would change the language that's included in that letter, as well as any new accounting pronouncements that are implemented from year to year. Also attached to that are the journal entries. So it's the fifth bullet point there. You can see the corrected and uncorrected misstatements. Again, the corrected are those journal entries that were made related to the audit, and sometimes just to convert it from cash to accrual basis of accounting. Others may be truly correcting entries that maybe were just missed postings internally that were needed to be made to have the financial statements be materially correct. And then we also have uncorrected misstatements that are included there. And that's typically if a journal entry were to not be made for any reason, then those are included and attached to that letter as well. So those are sometimes known as uncorrected adjustments or past adjusting journal entries.
Kevin, we have a question.
Mm-hmm.
Could you please review the fact that you are not accountable to catch fraud? If the gentleman understood correctly, are you also making internal safeguard recommendations?
Mm-hmm. So what I'll say to that is, as part of the audit, again, the purpose of the audit is that we're issuing an opinion that the financial statements are materially correct. As part of that, we also go through processes to try to ensure that fraud is not being incurred or on a regular basis or has occurred during the time period in which we are auditing. So because of that, we're not issuing an opinion on fraud, but certainly if we were to come across something, we would bring it to management's attention or to the board if it was management who was perpetrating that fraud. But again, we're designing our procedures to issue the opinion that the financial statements or DCD report are materially correct. So while we're not accountable, unfortunately, again, if we do come across something, and again, we would likely be able to see it potentially as part of the audit, again, we're not issuing an opinion on that. If we do come across something that maybe it's an internal control related matter that could leave the township susceptible to fraud, we would communicate that to them. And that's sometimes where those significant deficiencies or material weaknesses in internal control come into play. We have to report on those. Again, if there is a lack of segregation of duties, if you have one person that's handling the cash receipts function from beginning to end, that leaves you a little bit more susceptible to fraud. We would make you aware that you have a segregation of duties issue. It doesn't mean that we found anything, but by having that lack of segregation of duties, unfortunately, that opens up the township to be more susceptible to fraud. The only other thing that I'll mention when it comes to fraud And I'll have to double check the report here, but there's what's known as a report to the nation that the certified fraud examiners issue on a regular basis. And when they ask the general public, what's the most likely way for fraud to be caught? And at the top of that list every time is external auditor. And then they go through and they actually go analyze and research fraud that is committed. And when it's how was the fraud actually detected, the external auditors are about number 8 or 9 on the list. So unfortunately, again, as your auditors were not there an extended time period, it's hard for us to see every transaction. We're not looking at every transaction as part of our audit. And unfortunately, again, when I mentioned we're number 8 or 9 on the list, by mistake is typically more common than your external auditors as far as catching that fraud. So again, we design procedures, but again, not the purpose of the audit, a financial statement audit. So hopefully that helped to answer the question. If not, please feel free to respond back, and I'm happy to elaborate a little bit further. So next, I just wanted to move to just some potential areas in which organization can improve. These are just some key audit areas as they relate to the financial statements themselves and the overall impact they have on the financial statement. So I just want to kind of walk down through these. I realize not all of these may be applicable to your township, but you just want to talk through them. And I want to make sure that I hit the slide here on the schedule of expenditure of federal awards as it relates to the ARPA funding, which again, I know has significant impact on the townships that are included here on this call. So starting with the first item that I had are just related to capital assets. Typically just some items that we see and just some recommendations that we have are related to the additions of the capital assets. We really just recommend to track those additions throughout the year. What we've typically seen is with an organization, they try to wait till the end of the year, go back through and determine, well, what did they purchase? And they may have a capitalization policy of $5,000, and then they're trying to pull invoices for everything over that dollar amount, determine whether or not it's capital asset or not. So it's much easier to maybe flag those, make a copy of those, but just have a tracking process for any additions that you may have during the year. Also included in those additions are what's known as retainage. If you have significant projects that you have ongoing or open accounts, those typically have retainage that are included as part of that, where a certain amount is retained and not due until after the project is completed. And that needs to be included as a payable because that work has been completed. It's just not due at that time period. So we just really recommend to review that retainage payable for any significant contracts that you may have open during the year. You also just want to go through any disposals. Again, as it relates to capital assets, it's fairly easy to track something when you purchase it. But on the flip side, if you place something out of service, especially if it's just scrap, it may not cross the accounting system or the general ledger for part of that unless you're selling it for an amount. So you just want to make sure that that information is being communicated to the appropriate individuals that are tracking those disposals. And then on a regular basis, just take a physical inventory to ensure everything on your capital asset listing is still in possession of the township. So that can be done. Again, doesn't have to be necessarily every year, although it'd be great if it was, but just to be able to perform that physical inventory of all the capital assets. Obviously, there's disclosures associated with the capital assets, and that just shows your beginning balance, additions, deletions, and ending balance. Typically, what we try to include if you have multiple projects ongoing is to provide a breakdown of what those construction in progress may consist of. And it just gives you a breakdown of the individual projects and how much has been incurred to date on those. And also another required disclosure is related to the commitments. So if you have signed contracts for various projects, it just kind of says, here's the total price of the project, here's how much has been incurred to date. And again, subsequent events sometimes come into play. If you sign a large contract or a commitment after year end, you still want to disclose that in the financial statements because that's information that's useful to the readers of the financial statements to basically show what you've committed to spend in the future. Next, I just want to turn your attention now to the interfund accounts. When I say interfund, again, if you have multiple funds within your township, this is just the activity that's occurring between those. There's two different main types of interfund accounts. You have your due to, due froms. Those are your balance sheet accounts. And then you also have your transfers, which are more your income statement side of things. Unfortunately, as the auditors, we typically see a little bit of confusion between the two. Sometimes maybe the due to, due froms don't equal, and they should. Obviously, those are amounts that are owed between the funds as of year end or as of any given point in time. So you should be able to look at all the accounts that are due to, and those are your payables that are due to other funds. and those should be offset amongst the other funds, the respective funds, as due from accounts or accounts receivables. So maybe there's the example that I have here is maybe the general fund pays the salaries related to highway projects that are ultimately going to be paid by the highway aid fund. So the salaries are incurred by the general fund, going to be reimbursed by the highway aid, and maybe that reimbursement just didn't occur as of the year end. So that's still owed. The cash is physically owed as of the end of the year, but you move the expense over, but the cash just needs moved over. So you still have a due to, due from between those funds that are included there. So that's what a due to, due from is. And again, you want to make sure that they equal at any given point in time. If you do issue a financial statements, again, if for some reason there's an amount that's not going to be paid back in more than 1 year, you basically want to move that. It's no longer what's considered a current asset or current liability. It's considered long-term. So that should be appropriately split out on the financial statements as such. And again, if you've had a long outstanding item that hasn't been paid back, you just want to look into that and determine whether or not it will be. And if not, then it'll be recorded as a transfer and forgiven during that time period, essentially to eliminate that due to, due from. On the flip side, I know I mentioned it there, but it's the transfers. Those accounts for the activity that will not be paid back between the funds. So typically, if the general fund, for some reason, were to purchase a piece of equipment on behalf of another fund and the other fund's not going to pay it back, that's considered a transfer to the other fund. So you want to account for those appropriately. And typically, if you have a capital projects fund, or maybe it's a highway aid fund, and you want to move monies over to those funds and it's not going to be paid back, those are considered transfers. So that's, again, more the income statement side of things. And at any given point in time, again, the transfers in and the transfers out should equal amongst each of the individual funds when you look at them in total. Briefly, I just want to touch on leases. It's a significant disclosure as well. And there's two different types of leases. There's what's known as a capital lease or an operating lease. And basically a capital lease on the government-wide statements and in the proprietary funds, which again are reporting under the full accrual basis of accounting, you're going to record a capital asset and offset that with a liability. The year you enter into that lease, it's going to be considered a revenue and expenditure in the governmental funds themselves. So I have the criteria here for a capital lease. Again, the most common that we see is either that the end of the lease, the title was passed to the lessee, or maybe it contains a bargain purchase option at the end of the lease where you can purchase that piece of equipment or whatever you're leasing there for $1. That's considered to be a bargain purchase option. There's also two other ways for it to become a capital lease, and we really just recommend as you enter into a lease, review that with your auditors to ensure the appropriate reporting, whether it be capital or operating. And on the next slide, basically, you're just going to incur an expenditure as those lease terms become due. So as you enter into a lease, we really, again, just want to make that determination whether it's capital or operating. So you just want to obtain the lease document itself, the lease agreement, as well as the amortization table for that, which shows the breakdown between the principal and interest to ensure appropriate reporting. This will be changing effective for the year ends December 31st, 2022. Essentially, if you have a lease that you're going to have for more than 1 year, and whether it has options or not as well. So unfortunately, you can't enter into a lease and just have 1 year options year to year. That doesn't meet that definition. But essentially, most everything is going to be reported similar to a capital lease and reported as an asset or liability on that full accrual basis of accounting. So it's not effective yet, but will be for your financial statements here for the year ended 2022. There's also some items that are included in your financial statements, which are known as deferred outflows and inflows. And again, that terminology as it relates to deferred are strictly defined by GASB. That's the Government Accounting Standards Board. They dictate and they drive the financial statement format as well as the information that's included there. So those deferreds, inflows, and outflows have to meet strict definitions. If you have something else, there used to be what's called deferred revenue, which was a liability. That's basically called unearned revenue if you do have a liability as such now. So if it doesn't meet one of these two definitions, it can still be unearned revenue, but you can't use that terminology as far as deferred. And I just have some examples there. Again, typically most common for the entries that your auditors will be making remains a loss or on bond refunding, lease refunding, or sales of future revenue or the outflows. Then you can have inflows for unavailable tax revenue, or maybe you're receiving grant funds that have formal restrictions as part of that process. And then the last one is also related to pensions and OPEB related items. So again, if you have GASB 68 for pensions or OPEB, those also have related deferred inflows and outflows.
Kevin, we have another question.
Okay.
When the list of bills is approved at the BOS meetings, the list is included and it is approved subject to audit. What does that really mean? I'm one of the two signatures on the checks as treasurer member of the board. The other signature is our manager. I've looked over the checks and invoices when I sign them, but I don't know if that is enough. I'm not an accountant by profession. Any suggestions?
Sure. So I'll say that stamp, I can't say definitively what that means because unfortunately anybody can purchase a stamp that says subject to audit. What I will say, again, when it comes to looking at accounts payable and invoices, as your auditors, we do not look at every transaction. Again, we're setting scopes, we're selecting samples, we're not looking at every transaction of the township. So I'm not sure if internally, if there's an internal auditor that may be doing it part of that process. Sometimes it's the local elected auditors that sometimes are involved in that process. So I can't speak to exactly what your township is referring to there when they say subject to the audit. What I would suggest if you are a check signer is basically ensuring that the invoices are what you're approving, that there's an invoice behind it that matches up to that, and that looks like a legitimate township expenditure. That to me would be what you want to match up as part of that process. Again, hopefully that helps, but please feel free to contact me directly or add another chat there, and I can elaborate a little further. I'll briefly touch on fund balance. I want to make sure I get to the schedule of expenditure of federal awards, and I realize I'm pushing the 1 o'clock hour here. But as far as fund balance, again, you just want to make sure that you're reviewing those categories, making sure that if you do have the township has a fund balance policy, that you're in compliance with that policy. And again, you're reviewing it for any external restrictions, and that would be considered restricted fund balance. Or if it is unrestricted, again, has board taken action or appointed somebody else to either commit or assign fund balance. So those are just the other two significant categories that you want to make sure are appropriately accounted for within your financial statements, and review those classifications. Within the general fund, your other governmental funds are typically either restricted or committed. But again, you want to review each of those with your auditors to ensure appropriate reporting. So now finally, I just wanted to briefly touch on this as it relates to the schedule of expenditure of federal awards. Again, a lot of townships may be subject to what's known as a single audit for the first time with receiving the ARPA funding. But essentially what you want to do is each year that you have federal grants is prepare a schedule of expenditure of federal awards. And this is going to ensure that there's a process in place that you're including all of your federal grants. So if you're a township and you have CDBG funds that you receive, those are federal dollars. Any grants that you have, you want to make sure whether or not they are federal or state. This schedule, strictly federal awards, so you can exclude all the state and local awards. But just because you receive something from a state or local agency, it doesn't mean it's federal dollars. If the federal agency passes it down to the county, the state agency, state to the county, county to the township, if it's originally federal dollars that's being passed down through, that should be included here on your schedule of expenditure of federal awards. And the biggest thing there is to look for what's known as the CFDA number. And this just changed last week. It might be called an assisted listing number, but that's a 5-digit number that's included there to identify those federal grants. You want to make sure that you have that grant number because that's identifying that it is indeed federal dollars, and also include the grant name. Again, if there's a pass-through grantor number, have to separately identify COVID funding as part of that. And what really drives the single audit requirement are the expenditures incurred. And then you also have to include the amounts passed through the subrecipients and an indirect cost rate if there is one. So what I've used the term single audit. What does that mean? So essentially, a single audit is required if your federal expenditures exceed $750,000 in a fiscal year. So you may be awarded an ARPA grant for $1 million, and if that's your only federal grant, and you spend that over a 3-year period, and no 1 year did you spend more than $750,000, it's not going to be subject to a single audit. Your compliance is still important for that, and you still want to make sure that obviously you are following the compliance, but a single audit will not be performed. If you do have the federal expenditures for all of your federal grants that exceed $750,000, then basically your auditors are going to test certain federal programs. And those federal programs are driven, again, at $750,000. Any program that's more than that you expend more than $750,000 in one fiscal year, then that program must be tested as part of that single audit where you're looking at a single program. Just because you have a program that's less than 750,000, it still may be tested. Obviously, there's certain coverage requirements that are included as part of that single audit, so those programs still might be tested. I listed out here under the second bullet point, as far as the compliance is concerned, what are the most common compliance requirements, and you just want to make sure that there are appropriate policies in place as it relates to each of those compliance requirements for those federal dollars. Again, I know the ARPA funding is brand new. Everybody's trying to get their hands wrapped around it. We really just recommend to work with your auditors if you're concerned or if you want a second take on the compliance. As your auditors, we can't make decisions on what you should spend the money on, but we can assist in the process as it relates to compliance or offer our suggestions as it relates to that. What drives our single audit testing is what's known as the compliance supplement. That's put out on an annual basis, and it's really kind of our program that we use. I call it an audit program for the federal programs that we'll be testing as part of that single audit. And that's, again, issued on an annual basis. One last bullet point that I had related to potential areas to improve your organization is related to component units. Typically not too common for townships, but you just want to review that. If you do have a water or sewer authority or any type of other organization that might be related and should be included in your financial statements, that's considered a component unit. So if you have anything that you feel like might be the case, again, recommend to discuss that with your auditors. There's a checklist that they can help with that. Again, water and sewer authorities are the most common. So last item, very last bullet point that I have here, it's just as we all have evolved again over the last 18 months into more of a remote workstation. When it comes to internal controls, it is super important to maintain internal controls and maintain that segregation of duties. Just because you're in a remote environment now, or maybe somebody is, you don't want to remove those controls just for simplicity or for ease of completing it. Again, you want to maintain as many segregation of duties as you can, have as many different individuals involved in a process, and have the appropriate reviews and approvals for each of those transactions so that those are not, again, eliminated just because you're in a remote environment. And then again, just circle back to your policies and procedures from both the accounting and financial reporting perspective. Those are important. And again, you want to make sure that those are updated for any changes that are made within a remote environment. I know that was a lot of information. I hope concise enough for you there. Again, I hope that provided some information as it relates to information to communicate with your auditors. And again, kind of a mix there of information on when to communicate and how to communicate. But I'll certainly open it up for any other questions. Again, I know I'm pushing up against the 1 o'clock hour. Maybe if I didn't elaborate on something, I'm happy to do so a little bit further.
Kevin, we've had someone ask if you could explain the difference between internal and external auditors.
Sure. So unfortunately, internal auditors aren't very common within government entities, but it can exist. Basically, an internal auditor is somebody that is employed by the organization. So a lot of times I think what it would be somebody would be on payroll for your organization or for your township, and their job would be to perform internal audits. We can't rely on that work as your external auditors. Your external auditors are a hired firm, typically a hired CPA firm as part of that process, where we're coming in and we're not obviously employed by the township. So internal are internal employees, whereas your external are typically your certified public accountants and are qualified to issue and ultimately issue an opinion that the financial statements are materially correct.
Is that also elected auditors?
So elected auditors are, I'll say, typically they're kind of in between. Obviously, they're elected and or appointed. But unfortunately, with elected auditors, sometimes they may not have the background. I know their qualifications are somewhat limited in order to be an elected auditor, but I would consider them in between. Again, we as external auditors are not able to rely on any procedures that they perform. We still have to perform our full external audit function, even if they are in place as elected auditors.
So the follow-up to that is, what can we ask elected auditors to do?
So the elected auditors, I know if you have a township supervisor that performs work, I know they're involved in setting their pay rate for them. I know some places we go where we are still the elected auditors, we may audit the DCD report, and they're kind of involved in the wrap-up process just so they're made aware as well. Obviously, in Pennsylvania, a township law does not require an external CPA audit. So in some organizations, they're actually auditing that DCD report. They're signing it, again, as the elected auditors, which is a little bit different. They're not issuing a full report, similar to what we do as CPAs, and we're required by our standards. So hopefully that helps differentiate between the two. But again, we're not typically as involved with what the elected auditors may be doing. That's just kind of what I've seen with some of my experience.